Thank you for participating in this pre-recorded Federal New Market Tax Credit webinar, which is being provided by Community Reinvestment Associates. We are providing this 20-minute webinar for the purpose of providing a big picture overview of the New Market Tax Credit Program for those who want an initial understanding of the program. On our website, we also provide a detailed two-part webinar. Part 1 is entitled The Basics, and Part 2 is entitled Steps in Structuring. Each part is approximately 45 minutes in length. For purposes of taking notes, you may want to download the PDF located in the purple tab, which is located under the orange tab on our website that links to this 20-minute webinar. This PDF is a copy of the slides used in this webinar. If you are viewing our webinar on YouTube or another website, our website address is set forth at the bottom left side of this presentation. If you have any problems printing the PDF, please contact us and we will promptly email a copy to you. Before we proceed, we would like to provide a brief introduction to our firm, Community Reinvestment Associates, and how we assist our borrower clients. We are a national financial consulting firm that bridges the financing gaps related to financing real estate and equipment and business and nonprofit operations. We have represented small, medium, and large-sized borrowers in connection with closing over approximately $1.6 billion of new market tax credit financings over the past 20 years since the inception of the program. Borrowers apply to investors and those who have received new market tax credit allocation authority awards, which are known as allocatees. Borrower applications must be persuasive, well-written, and provide significant details supporting the direct and indirect community and economic impacts to residents in economically distressed communities and to other targeted populations. Proactivity in completing these applications and strategic timing in submitting these applications is critical. With respect to new market tax credit financing applications filed on behalf of our clients, we serve as a gateway of credibility. This is because we sign off on all of the legal, underwriting, tax, and structuring requirements as being satisfied based on our 25 years of finance, legal, accounting, tax, and community and economic development experience, as well as our relationships with new market tax credit financing participants. We quarterback each new market tax credit financing from start to finish, and our fees are contingent upon our securing such financing on behalf of our clients. In this webinar, we will discuss the intent of the program, as well as the economic benefits to a borrower, which can be in the form of either a forgiven loan or a non-forgiven loan, and each loan has additional favorable and non-traditional economic terms, and the borrower is also able to benefit from flexible underwriting criteria. There are several permitted uses of new market tax credit financing, but there are a few prohibited uses. The program requires that the borrower project be located in a low-income census tract, and the more economically distressed the census tract, the more likely a borrower is to obtain new market tax credit financing. We will also discuss the desired community and economic benefits to residents in low-income communities and other targeted populations, which is the purpose of the new market tax credit program. And based on these community and economic impacts, we will discuss and describe good borrower and project candidates. We will then discuss the sizing of new market tax credit financing. And finally, we'll discuss our services to secure new market tax credit financing on behalf of our clients. The intent of the program is to provide investment capital to low-income communities which have traditionally lacked access to financing. The program is not intended to provide better financing to those who have obtained or can obtain financing, but rather it is intended to provide financing for any shortfall in available financing. The program particularly focuses on the benefits and impacts to the residents in such low-income communities and targeted populations, such as low-income persons, minorities, women, veterans, and other populations who have traditionally lacked access to quality jobs and vital community and consumer goods and services. New market tax credits are equal to 39% of the new market tax credit financing, which is known as a qualified equity investment. The program subsidy is provided from an investor's effective purchase of the tax credits. It is important to note that an investor does not receive any direct or indirect ownership interest in the borrower or any of its affiliates. The Community Development Financial Institutions Fund, which is a division of the U.S. Treasury Department and known as the CDFI Fund, administers the program. Each year, the CDFI Fund provides $3.5 billion of non-monetary new market tax credit allocation authority awards to qualified applicants. If an applicant receives such an award, it becomes an allocatee. An allocatee is then authorized to designate a new market tax credit financing as a qualified equity investment, which then permits the investor to recognize the tax credits. An investor makes a qualified equity investment in an affiliate of the allocatee, and it is that affiliate that provides the new market tax credit financing down to the borrower. Borrowers must compete to obtain new market tax credit financing from allocatees and investors, which is an extremely competitive process. New market tax credit financing may be used for profits and nonprofits to acquire, construct, renovate, and expand bricks and mortar projects, including those related to healthcare, education, manufacturing, retail, qualified mixed use, cultural, community, and renewable energy and recycling. It can also be used to finance business and nonprofit operations, such as those in the nature described above, including the purchasing, refurbishing, retrofitting, or leasing of equipment, and/or funding working capital, inventory, and staffing. However, new market tax credit financing may not be used generally to refinance or prepay existing debt, but there are exceptions. For example, if debt is maturing and the borrower cannot otherwise pay it off or refinance, or the borrower is not able to make timely debt service payments on its existing debt, the new market tax credit financing may be able to be used provided that the business or nonprofit would be partially or completely shutting down, resulting in significant direct or indirect job losses, direct or indirect losses of community and consumer goods and services to the community, and/or any other direct or indirect negative economic impacts in the community and other targeted populations. New market tax credit financing also cannot be used to finance a so-called sin business, such as a gambling facility, racetrack, or a business the principal activity of which is selling alcohol off premises. New market tax credit financing also cannot be used to participate in a transaction or series of transactions which is contrary to the intent of the program. This would include, for example, that a borrower could easily have obtained traditional financing which is not overly burdensome. Generally, with respect to the forgiven loan, it only requires approximate 1 to 1.2% interest-only payments during the 7-year compliance period, and it is forgiven at the end of the compliance period. Generally, with respect to the non-forgiven loan, it only requires below-market interest-only payments during the compliance period. And although the interest rate is not as low as the interest rate of the forgiven loan, it is still a below-market interest rate. And after the 7-year compliance period begins to amortize up to 40 years, which can be well beyond the useful life of any secured asset. Nevertheless, even though there is a below market interest rate, after the 7-year compliance period, the borrower is permitted to prepay or refinance all or a portion of the non-forgiven loan. Generally, the benefits of the program, whether in the form of the forgiven loan or the non-forgiven loan, include gap financing. As previously discussed, the program is intended to provide the final piece of financing required, and also as previously discussed, below market interest-only payments during the 7-year compliance period. Each loan is generally subordinated to the borrower's existing and subsequent creditors. Each loan includes non-traditional and favorable economic terms, such as even longer than standard interest-only payments or debt with equity requirements. Additionally, there are many flexible underwriting criteria, such as not requiring a significant prior business history, permitting higher loan-to-values, which can be far in excess of 100%, not requiring appraisals on any secured collateral, accepting non-traditional collateral such as inventory, limiting the amount of personal guarantees or scenarios for which they are applicable or eliminating them altogether, lower debt service coverage ratio requirements, and minimum equity requirements, which are generally only 3 to 5% and are only really required to support a certain tax opinion at closing. However, this equity can often be withdrawn soon after the closing. One of the most significant benefits is that the program permits the borrower to leverage its other sources of financing for a multiplier economic benefit, which is discussed in part 2 of our detailed webinar. Moreover, there are softer foreclosure and enforcement rights if there is a default. A foreclosure can arise if the borrower defaults in making its below-market interest-only payments during the 7-year compliance period, or the borrower otherwise breaches the terms of its financing documents for whatever reason. In such a case, if principal is paid back during the 7-year compliance period, the program requires that such principal be redeployed to another low-income community within 6 months. Thus, the investor and allocatee are motivated to work with the borrower in connection with any financial issues because the investor and allocatee do not have any capital at risk. Specifically, the investor has purchased the tax credits and doesn't expect the return of its purchase price, and the allocatee merely facilitates the financing without using any of its own funds. If applicable, state new market tax credits provide an additional subsidy. A state investor purchases these state new market tax credits in order to apply them against its state income taxes. Approximately 25% of states have their own state new market tax credit programs, which generally follow most of the legal and underwriting requirements of the federal new market tax credit program. A state investor may or may not be the same as the federal investor. Often, the new market tax credit financing provides the ability of the borrower to obtain other financing given that, as previously discussed, each of the forgiven loan and non-forgiven loan is generally subordinated to other creditors. The forgiven loan is forgiven and therefore is viewed as a grant and not debt, and the non-forgiven loan has low debt service payments over up to 40 years, which can be well beyond the life of any secured asset. Therefore, it is viewed as patient capital. Thus, creditors and equity providers are more likely to provide additional financing based on either form of new market tax credit program subsidy provided. And finally, the program results in substantial community and economic impacts to residents in low-income communities and targeted populations, including low-income persons, minorities, women, veterans, and other populations who have traditionally lacked access to capital, jobs, and vital community and consumer goods and services. One of the legal requirements is that the borrower or the project finance must be predominantly located in a low-income community on the date of the funding of the financing. We discuss all legal requirements in part 1 of our detailed webinar. We can confirm that any particular borrower or project address is located in a low-income community. However, please note that a low-income community is defined by U.S. Census data as a census tract with either a poverty rate of at least 20% or, depending on whether the census tract is located in a metropolitan or non-metropolitan area, satisfaction of the applicable 80% median family income test. This requirement must be satisfied on the date of the funding of the new market tax credit financing. If the census tract subsequently does not qualify as a low-income census tract, the requirement is still satisfied because the requirement must only be satisfied on the date of the funding of the new market tax credit financing, provided that the borrower's operations or project as applicable remains in such census tract. However, a borrower's operations or project can be relocated during the compliance period as long as such relocation is to another low-income census tract and it receives the consent of the investor and the allocatee. New market tax credit financing is much more likely to be provided to a borrower project which is located in a highly distressed low-income community, which includes a census tract that has either one of 4 primary distress criteria or 2 of several secondary distress criteria. Primary distress criteria include a poverty rate of at least 30% compared to the statutory minimum 20% that we just discussed, or being located in a rural community. The other two primary distress criteria include an unemployment rate that is 1.5 times the national average, or having median family income below 60% compared to the statutory minimum 80% median family income, as we just discussed. Alternatively, if at least two of several secondary distress criteria characterize the low-income community, the low-income community is also considered highly distressed, such as having a poverty rate of 25% compared to the statutory minimum 20%, or satisfying any of several other secondary criteria, such as being located in an enterprise zone or otherwise designated as distressed by a federal, regional, state, or local agency. Some of these secondary distress criteria only apply to certain types of borrowers and projects. For example, if the borrower is a grocery store, a secondary criteria would include that it is located in a food desert, or a healthcare facility would include that it is located in a medically underserved area. However, a manufacturing facility being located in a food desert or a medically underserved area does not count as a secondary distress criteria. The more highly distressed, specifically the more primary and secondary criteria that characterize the low-income community, the more likely an allocatee and an investor will be interested in participating in the new market tax credit financing with the borrower. In fact, all allocatees that received allocation awards from the last annual award round have committed to provide 75% of their allocation awards to highly distressed low-income communities or to low-income census tracts with very high unemployment rates. As previously discussed, the program is intended to provide vital community and economic impacts to economically distressed communities and targeted populations. A borrower must qualitatively and quantitatively provide support of substantial community and economic impact to residents in low-income communities and other targeted populations. It must also execute a community benefits agreement. These community and economic impacts include any of the following: direct and indirect full-time and part-time job creation, job retention, and construction jobs, as well as such jobs being accessible to low-income persons. Jobs that provide living wages, health care benefits, retirement plans, life insurance, job training, and continuing education. Consumer and community goods and services. If the project has tenants, such tenants provide community impacts, and below market lease rates are provided to minority-owned or women-owned business tenants or other favorable terms. If the project is mixed use, affordable housing is partially provided with rent restrictions for low-income persons and other targeted populations. Another community impact includes green-type benefits, such as satisfying LEED standards, and any other community benefits, such as the renovation of historic properties or reducing blight. No borrower can check all of the boxes. However, as many boxes as can be checked, the better. Borrowers are required to execute a community benefits agreement, pursuant to which they are required to use, quote, commercially reasonable efforts so that its projected community and economic impacts are realized during the 7-year compliance period. Each of the following are good types of borrowers and projects for new market tax credit financing because they provide substantial community and economic impacts. These include those involving manufacturing because they involve jobs, training, and living wages; healthcare because it provides critical health, urgent care, and other services, especially if located in a medically underserved area; grocery because it provides critical consumer goods, including healthy foods, especially if it is located in a food desert; education because it provides education, especially if provided to low-income persons or children of low-income persons or other targeted populations; qualified mixed use if a percentage of residential units are rent restricted for low-income persons and targeted populations, and non-residential tenants provide community and economic benefits; community facilities such as museums, cultural centers, libraries, youth centers, and community market venues; and renewable energy and recycling facilities because they provide green-related benefits. New market tax credit financing, that being the qualified equity investment, is the sum of the investor's purchase price of the new market tax credits and the leverage sources, which include the borrower's other sources of funds, which can include other debt and equity sources, and federal, state, and local subsidies, and 2 years of prior expenditures, provided that at least 51% of them are primarily capitalizable depreciable. New market tax credit financing may be only part of an overall larger financing. Generally, in order to receive the forgiven loan, there must be a shortfall in available financing of at least approximately $1.5 million, and the leverage sources must be at least equal to approximately $4.5 million. Generally, the non-forgiven loan and the new market tax credit financing each must be below approximately $2 million. We discussed the overall sizing and structuring of new market financing in part 2 of our detailed webinar. Applying to investors, allocatees, and other new market tax credit financing participants is extremely competitive, even for a borrower that will use the new market tax credit financing to provide various substantial community and economic impacts in a highly distressed low-income community. As we discussed, our fees are contingent upon the securing of new market tax credit financing on behalf of our clients. We have profiled all allocatees and investors and have developed our intake form, which incorporates each allocatee's and each investor's intake form questions, which vary among investors and allocatees. This permits us to timely and strategically complete our targeted allocatees and investors' intake forms in an efficient, timely, and strategic way. We are able to use our continually updated profiles of allocatees and investors to persuasively respond to their intake form questions and obtain and provide required due diligence materials in order to support that our borrower client satisfies our targeted allocatees and investors' particular underwriting requirements. These requirements may not be reflected in their intake forms. However, we are aware of any non-published underwriting requirements based on our prior experience with these allocatees and investors and continue dialogue with them. We also have significant experience in writing grants and reviewing grant applications on behalf of the CDFI Fund, including applications submitted by potential allocatees each year. This provides us with a background that permits us to provide a persuasive and cohesive narrative, which is supported by necessary and critical analysis of our borrowers' clients' particular facts and circumstances in connection with submitting new market tax credit financing applications to allocatees and investors. Upon engagement, we will provide our client with our comprehensive intake form, answer our client's questions in connection with completing such form, answer many of the questions ourselves based on our research to support that the structure of the overall financing satisfies legal, tax, underwriting, and structuring requirements, including all of the allocatees, investors, and leverage lenders' unique underwriting requirements will be satisfied. Leverage lenders are either the sources of the borrower's other financing or financing which we have identified and secured on behalf of our client. We discuss leverage lenders in part 2 of our detailed webinar. Additionally, we identify all applicable primary and secondary distress characteristics of the census tract and properly document them. We qualify and quantify direct and indirect community and economic impacts based on third-party or industry standard modeling. We independently confirm that there is strong local support, and if applicable, we confirm and document that there will be or could be catalytic subsequent economic and community development as a result of the new market tax credit financing. We confirm that such other relevant facts and circumstances are supported and documented, and manage the overall financing from start to finish. We identify and solicit allocatees for maximum suballocation of their new market tax credit allocation awards, maximum forgiveness of the forgiven loan, optimal economic terms, optimal flexible financial underwriting criteria, and low suballocation fees. We also identify and solicit investors for optimal new market tax credit pricing. The higher the price, the higher the program subsidy to the borrower. Other optimal financing terms, and optimal flexible financial underwriting criteria. We also identify and solicit leverage lenders to the extent that our client has not identified leverage lenders for the amount of leverage funds needed, or its 2 years of prior expenditures. 4. Optimal interest rate, optimal financial terms, and optimal flexible financial underwriting criteria. Again, we quarterback each new market tax credit financing from start to finish, and our fees are contingent upon our securing such new market tax credit financing on behalf of our clients. If you have any questions regarding this presentation, please email us or click on the green tab entitled Contact Initial Intake Form, which is located at the top right side of our main website page. This brief intake form is not our comprehensive form, but can be used as an initial question and answer form. Additionally, upon request, we provide live webinars targeted towards specific industries and borrowers during which participants may ask questions. These webinars are at no cost. Again, thank you for taking the time to participate in this webinar, and this now concludes our webinar.